Okay, let's go ahead and get started. Doesn't look like we're going to get anybody else right now. Welcome to the Property Management Task Force. Can I get a motion to approve the minutes?
I think we have a quorum.
Oh, we
I
don't?
make a motion to approve the minutes. Robin,
Okay. Second?
I'll second it, Sheila.
Okay. Okay, thanks. Okay, all in favor? Aye. Motion carried. Okay, so our guest speaker is Tiffany, and I understand you're there, right, Tiffany?
I'm here.
Okay, so you go ahead and you can start now.
Okay, do I have a way to flip through this? Or just tell them when it's next slide?
Oh, next slide.
Yeah, you can tell me next slide.
Okay, thank you. So,
Do you want me to minimize that window up?
whatever's easiest, I'm easy.
I just don't know if you want people to read what you have up there. If you're
Oh.
gonna cover it.
So I'll just start by just introducing, I know most of you, but my name is Tiffany Cross. I'm the owner of Dedicated Credit Repair. This is our 16th year in business here in the Valley. And we are of the 3% nationally of credit repair organizations that are consistently approved by the Department of Justice. So we can legally work with clients in almost every state, with the exception of Georgia, where credit repair is not allowed at all, and Oregon. So those two states have completely dismantled the idea of credit repair, which is bizarre, but it's what's happened. But nonetheless, we literally have helped tens of thousands of clients nationwide. And our goal is to, of course, offer credit repair in the most ethical and strategic way possible and the most efficient way. So when you work with us, we're transitioning your clients, most of which are trying to buy homes. So I have a ton of new content today that I want to go over, but I do need to talk about a few just basic FAQs that I think you're going to find pretty helpful. My information will be at the end of this slide as well. But anyhow, thanks for having me, and please interrupt me if you have any questions. Next slide. Okay, I want to talk briefly about the word credit. Unfortunately, in the world of credit, the word credit is overused and it's misused. So for example, a lot of your clients are coming to me saying my credit application, and they're confused completely with the fact that, for example, your income has absolutely nothing to do with your FICO score. So when somebody's applying for a mortgage, we always ask them, are you talking about a credit application for rental? What exactly are you trying to repair? Because a lot of times people say, well, I completed a credit application and was denied. And unfortunately, a credit application asks about a lot of things that is not relevant to the FICO score. So that's the first and foremost. We always want to talk to clients and properly educate them. Are they trying to qualify regarding debt to income, because that's outside of the FICO score calculation. So just moving forward, whenever we talk to clients and they say, I got a credit report, we immediately ask, where did you get the report from? Because as you guys mostly know, there's a FICO score and everything else is FICO scores. So just know that if you're not sending your client to myfico.com, or the credit report wasn't provided by a mortgage lender, it is absolutely a score that's useless and nobody uses. The consumer reports like Credit Karma, Experian, all of the scores that are generated on those reports are called Vantage scores. And forever, for 16 years of doing this, it used to be the Vantage score was always about 40 to 50 points higher than the true FICO score. During COVID, we saw that shift. So now suddenly the Vantage score looks less amazing than the true FICO score. And the reason for that is that the FICO scores typically care about the last 2 years the most over the last 7, whereas the FICO score has always cared about the most recent 4 years. So with COVID and all of the things that have happened, you can tell why the last 2 years would be challenging for people. So this is where we tell people now more than ever, please send your clients to myfico.com so they're getting a true FICO score. And quite frankly, when they go to that website, they're going to get 9 different, very commonly used FICO scores, from mortgage to auto to credit card, etc. So as always, I'll say if it's not a FICO score, it's a FICO score. So remember that if you can. Okay, next slide. Okay, the three credit bureaus are commonly misunderstood. A lot of people think that when they go directly to the credit bureaus for a report or content, that the information is accurate. It is and it isn't. So be careful when you go to the credit bureaus or you go directly to dispute something directly with the credit bureaus. You're truly not communicating at all with Fair Isaac Corporation, which is FICO. So the three credit bureaus are nothing more than data furnishers that supply the data to FICO. FICO creates the algorithm that determines your risk score. So again, go directly to Fair Isaac if you're trying to look at where you stand as far as the score itself. This is a big deal right now because there's a lot of new websites out there right now that clients are going to and being extremely discouraged when they find out that they're not qualified. Okay, so TransUnion, Experian, and Equifax are data furnishers, but they do not provide an accurate score. Okay, next. Okay, this is the FICO Score calculation module that we all know. This is very important. 35% of the FICO Score, which is the largest component in the FICO Score calculation, is in fact your payment history. So every time a consumer misses a payment on the 31st day of a late, it will hit your credit. And right now, the average deduction for one 30-day late has jumped up all the way from 60 to 80 points. 60 to 80 points for a one-time missed payment. Those payments, missed payments, will stay on the credit report or FICO Score for 7 years. So keep in mind, my biggest misconception that I'm talking to with renters right now is they'll say, well, that shouldn't be there because I paid it off. Paying it off doesn't remove it from the fact that it ever happened. It brings it current, which is wonderful because it stops the bleeding essentially, but it doesn't remove it from the credit report. So a lot of my clients right now are coming to us saying, well, I paid this collection, it shouldn't be there. And so we tell them, no, it should be there. It should just say settled. When you pay a collection account off or you bring something current, it will absolutely reactivate the date of last activity on the credit profile, dropping the score an average of about 25 points. So paying collections is something we don't want to tell clients to do until they've had a free consultation to determine whether it's going to help them or hinder them in terms of the loan process. So it's very, very important that clients understand the importance of their missed payments. And there is no difference between like a mortgage late and an Old Navy credit card late. They're all the same in the FICO Score world. Where it becomes important is when you're talking about underwriting guidelines. So clearly a mortgage late would be a little bit more significant than an Old Navy credit late, but the late payment, the amount of points you lose would be identical. Okay, so super important there. The second biggest component of the FICO Score is what we call the utilization ratio. This has changed a lot over the last 2 years. The FICO Score absolutely requires that a consumer carry a minimum of 3, no more than 5 open revolving lines of credit. Okay, so what that means is credit cards. We see a ton of people right now that are very installment loan heavy, where they have motorhomes and vehicles and student loans and all the things that calculate, but they don't have enough credit cards. So 100% you cannot be credit avoidant and have excellent FICO scores. So if you don't have 3 cards you're using pretty frequently, you'll be missing 30% of your score. So a lot of clients are coming to us right now in the mid-5s. They don't really have a tremendous amount of late payments, but they don't have adequate revolving credits. We're helping clients establish that.
Does it affect it if you pay off those credit cards every month?
It does. That's a really good question. So if you have a 680 FICO score and under, you don't want to be paying off your credit cards in full every month. I know. And remember that the reason why that's important is because the FICO score is not designed in favor of us. It's 100% designed in favor of the lending institutions. So they want to see that you're not credit avoidant, you are making on-time payments, and you're paying a little bit of interest, essentially. So again, you got to use the card to make on-time payments. Now, if you have a 700 FICO score and above, it is absolutely okay to pay them off in full every month. It's truly for the individuals trying to gain utilization ratios, okay? So again, this is another thing. The biggest hiccup I see right now is people paying off vehicles, refinancing vehicles and paying them off, and then wondering why they dropped 80 points. So a lot of mortgage lenders will advise to do that in order to influence the debt to income ratio, which we get. But when that happens, they can't be surprised that they've lost a tremendous amount of FICO score points. So at the end of the day, my biggest pitch to all my friends in the industry is get your client in front of us about 6 months before they want to purchase, so that we can absolutely tie a pretty little red bow around their neck and send them off to you with no surprises. Super important. The types of credit cards matter. This is different. It used to be just go down and get a bunch of retail cards. Okay. The problem with retail cards is that you have to buy frivolously to keep excellent credit. So Old Navy, all the retail cards, a lot of people will say, well, I haven't been using my cards. And then we have to tell them to go buy things, right? Better to absolutely consider credit as a marriage. And the longer you have the credit utilization in place, the more significant the scores will increase. So gas cards, things that air miles, things that you would already be using your card for very regularly, that's really where you want to go with it. So try to stay away from retail if you can, advise that. And that's definitely been influential in the last couple of years. Okay. 15% of the FICO score is the length of history. So the new FICO score index, which will be at the end of this presentation, is really, really concerning themselves with how long a credit card's been open, how long your credit established history looks. So if you have only 2 years of a credit line, not enough. They want to see 4 or more years. That's changed. Yeah. So part of that is because of the COVID issues that have happened in our industry right now, and they're trying to reward individuals who didn't just go out and obtain a bunch of new credit and then not pay their mortgage during this time. So that's been a huge, heavy trend. 10% has always been diversification of credit. Obviously, that makes sense. You want to have a nice portfolio, credit portfolio. And then lastly, 10% of the score is the credit inquiry section. You guys, the last 12 months, we've seen that a new hard inquiry used to be about 5 to 8 points. We're seeing it now 8 to 12 points. So every time you have someone else run your credit, you're going to see a substantial dip in that FICO score, and it happens immediately. So very important to not do that. Yes.
Just going back to the credit history, I know years ago, especially for first-time buyers with limited credit, it was jump on as an authorized user, and then you gained their entire. So I jump on to one of Connie's cards that she's had for 10 years. I now have 10 years of credit history, gives me score and all that. Does that still apply?
Yes, and it's absolutely amazing. And we tell everybody, if you have a friend or family member with excellent credit on that particular trade line, great way to do it. Just be added as an authorized user. You do not have to give the authorized user the card, right? So you can still do that. The key though is it has to be a long-standing account, which is 4 years or older. The credit balance needs to be below 25% of the limit to make it really affect in a positive way. Great thing to do for college students or even high school students. That's awesome. And actually, we're really recommending that more now than ever. Secured credit cards are also another option for that. We have some great local banks that we've been working with for the last couple of years that do not run credit. It's huge because a lot of times when you need secured lines of credit, you're credit challenged. And believe it or not, most of the banks were denying credit challenged people, secured lines, which is kind of difficult. So we found some local banks we're working with. I can send you a list of them right now, just off the top of my head. BBVA Compass, which is now transitioning, I think, to a new name, PNC. And also Banner Bank have tremendous secured lines right now. And they report to all 3 credit bureaus, whereas some secured cards only report to 1 or 2 credit bureaus. So we want to make sure it impacts all 3 right away. Okay, next slide. Okay, we discussed this kind of briefly, but the banks and lending institutions are who influence the FICO score, which, by the way, is why the Vantage score, the FICO score, is not utilized. The Vantage score takes into account so many things that are more in favor of the consumer, and it was just basically vetoed by most lending institutions because there for a long time, your interest rates were a lot lower as a consumer when they went with the Vantage score. So just know that the FICO score, the reason why Dave Ramsey and Susie Orman and all the big gurus hate the FICO score is because it's not financial wisdom that we're teaching. We're teaching FICO wisdom, and there's a huge difference. Very rarely does the information or the guidance that we provide for a consumer make any financial sense at all, which is a bummer. You'd think it would be, the other way around. But telling people not to pay off their credit cards every, month, telling them not to pay off a vehicle loan doesn't really make any financial sense. So my rule of thumb is to always set aside a timeline for the consumer, help them focus on the FICO score in order to accomplish their initial goal, and then educate them on how to transition into financial sense afterwards. Okay, next. Okay, best practices. So I want to talk about the fact that it is possible to blend not paying a tremendous amount of interest with, with FICO Sense. So what I like to do with my credit lines is I make a minimum payment for 2 months in a row. Third month, I pay it off in full, and then I don't use it again for about 60 days. So I'm really only paying a couple months of interest, and then I still keep them somewhat unused for a couple months. And I have found, by the way, that my FICO score used to be about an 830. I've never had higher than 830, and I've owned this company for quite a while. It's now 780. And that was kind of a thing for me for a while. I was like, oh gosh, I own a credit repair company and I'm a 780. But I have to tell you, the reason why it's a 780 is because I prefer not to be debt heavy. And I think bottom line is at 720 and higher, you can get best interest rates. So it's kind of like saying I'm okay with being an A-. I don't need to be an A+ on my dime. Does that make sense?
Yes, perfect.
So I'd rather teach my clients to be a low 700 or even mids and just be super content, because that means you're winning the game on both ends. Okay. The difference between someone with an 830 and a 740 is just they have a tremendous amount of debt. They may be on time with it, but they owe a lot of money. So just a little food for thought where that's concerned. Okay, next slide. Installment debt. This is what I was mentioning. A lot of people will ask me, should I start paying my student loans? They're in deferment, or would this help my credit? Believe it or not, your installment debt is specific to student loan debt, really not an issue unless it's late. So if you have clients with a lot of student loan debt and they're late, or something funky happened during COVID where they thought they were in deferment, maybe 2 of their loans were properly placed in deferment, but 2 of them weren't, please have them come to me, because there are so many rehab programs right now that we can quickly implement for them. All they have to do is make 3 or 4 on-time payments, and we can get all the late payments removed from that student loan issue. So that's now more than ever, this is the time. What I do see though is the assumption from consumers that they were automatically in deferment. And if they were not in some sort of contractual agreement, then we can't use the CARES Act to their advantage when we're disputing. We cannot do that. We can use other things, but the CARES Act only protects those who were in an agreed upon forbearance or deferment. Okay. So again, send your clients to us, because each of these circumstances has some caveats that are super important. And I'll just leave it at that. Okay, next slide. Okay, lack of credit we talked about. Just don't be credit avoidant. And sadly, I have to say, don't pay everything off every month. I hate that. I just hate saying that. It's just a big bummer. But especially now more than ever.
You don't get dinged if you pay them off, or you just don't get any higher?
You don't get any higher.
So
you don't
I'm
get
sitting
penalized.
around 7 to 80. Do I really care?
You don't. It's the 700s and above. You're doing all the right things, but it's for people that lack credit, that are not giving themselves a chance to report a utilization ratio. Yeah.
So while we're on that subject, so basically you're saying for my son, when he turned around and got his first loan as his auto loan and paid it off in 2 years rather than 4 or 5, in essence, he's not gonna accrue any credit.
That's correct. The reason why that works that way with a car loan is when you pay off the final payment of your vehicle, what happens to the loan? It's gone. It's closed. It's paid. You don't have an open balance at Mercedes to, it doesn't work that way. So once it's paid, it's closed, and all those months of on-time payments or years stops building on your credit profile. So that's why we don't love working on installment loan debt. Better to work on your utilization ratios regarding your revolving credit debt. Not fair. And I'm just the messenger, so don't hate me. Okay, next slide. Okay, credit inquiries. So the big misconception right now is that if I'm looking for a mortgage and one lender runs my credit once, and then I want to shop Adam's rate, so I'm going to go across the street to 2 other lenders, and as long as it's within 15 days, it counts as one inquiry. That is not true. That's how it's supposed to be, and that was absolutely supposed to be implemented that way. Who do you use when you pull credit?
I haven't pulled credit so long.
Credit.
CTI.
CTI?
CTI.
Okay, so if I'm lucky enough to have my second lender use CTI, then it would be one inquiry.
Oh.
But the chances of that happening are not very good. So remember, tell your clients, go to myfico.com, go into, especially when they're looking at cars. Cars dealerships are notorious for just blasting that credit profile out to as many different, lending institutions as possible. And then there's 15, 20 inquiries. It's
They
horrible.
can do that?
Absolutely. They shouldn't be able to, but they do.
Oh, wow.
Yeah.
Yeah, because for cars, especially they'll apply for a car loan where you say, I want this payment, and the dealer can use in-house financing. Nope, we don't get the right rate. That's not gonna work. I'm gonna go to Wells Fargo. Nope, that didn't work. I'm gonna go here.
Yeah.
And they're doing all that in the back, so that when they come out and say, hey, we got your payment,
Mhm.
you may not realize how much time it's been run.
It's a disaster. So, and the other thing that it should be heavily regulated more, and it isn't, is when you're establishing utilities. If they say it's a soft inquiry, they're lying. In fact, try to get him on camera saying that, because it's not a soft inquiry. So it just basically always know that if it's not you running it on your own self, to see your own credit, it's a hard inquiry. And boy, are they really coming down on those right now. They're affecting way more than they should. So that's a very easy section to repair, by the way. We can start removing inquiries unless the inquiry reflects a new trade line. So if you went to buy a car and you got the car loan, I can't dispute off the inquiry because it shows you got the car, right? So it'd be more for individuals that didn't want something ran and it was run against their will or without their permission.
So what's the impact on the soft?
Nothing.
Nothing?
What's the difference?
The soft inquiry is you going to myfico.com or you
okay.
doing it for
Well,
yourself.
because what's become, what I've seen personally more and more common is if you do have a credit card and they want to give you an updated, hey, check my score every month, or now even the banks are starting to do, you want to see what's going on, click here, and it's, I mean, I don't like.
Those are
doing
soft
that,
inquiries
but I know they're
unless
soft,
you
so-
obtained the loan that they were pre-approving for.
Yeah,
Yeah.
and usually it's just to keep track of your score,
Mhm.
like, I mean, I could open up one of my credit card apps, and the score is there, it's like,
Correct.
do you want to see your updated score?
Yeah,
Like,
I
you should
have
have it in
one that
time.
does that.
Keep in
So-
mind, those Discover card statements and all of those scores are what we call bank card scores. They're not FICO scores for mortgage.
Yeah.
So they have a huge swing on those. The pendulum swings quite a bit. Now, keep in mind, if you have a voluntary repossession on a car from 5 years ago, and you have something else, your auto FICO is going to be very low compared to your mortgage FICO. And believe it or not, it is so much easier for me to take someone from a 500 to a 680 for the mortgage than it is to take someone from 680 to a 720. I can go up 120 points in 4 months. Sometimes going from 680 to 720 takes a year. And a lot of that isn't about me. It's about the utilization of credit, the length of history, all the things that take time. So again, really important to just focus on, try to consider credit. The less you do, the better. In other words, the less chips you're moving at the same time, the better your scores look. So if you just refied a car and then you just did this and that, and you're doing 4 or 5 things at once, it's catastrophic to the FICO score. So try to do all the things you're trying to do at least 6 months before you buy the house, because the trauma doesn't go away. Okay, next one. I already talked about this one, FICO scores. Credit Karma is Credit Crappa. You can quote me. It's horrible. Please stay away from Credit Karma. It's confusing. The most recent nightmare for me is that all of the clients that are in my program that have some of these FICO score sites as their monitoring sites, keep in mind, they're trying to sell credit monitoring, right? That's the goal.
Yeah.
So when you subscribe to them, they will send you notifications that your information's on the dark web.
Yes, I have experience. I was freaking out for a while. Finally, I just started deleting it.
Yeah, it's just a way to get you to go, oh, dark web. The dark web is the internet. It's been around since what, the 70s, 80s now? So if you have been adulting for any length of time, you're on the dark web. So it's just a way to scare you into going, uh-oh, what changed? So you subscribe to their monitoring. So so that's important to know as well.
Oh, I am a sucker.
You're on the dark web.
I mean,
Whoa.
so when the
Change all my
consumer
email
goes,
addresses.
when they go onto the myfico.com website, do they get the real
Yes,
FICO
all 9.
score?
All 9, all of them. And it's $40. So that's kind of what
Okay.
people don't love. But
Okay,
you're paying for the real deal. And you're gonna see all of the variations of the scores.
And if we don't like it, we can come to you.
Come to me, yes, that's the goal. That's the
And
goal.
how long will that FICO score last?
30 days.
Okay.
A lot of times, okay, this is a new credit COVID thing.
Okay.
So used to be pre-COVID, was that BC, before COVID? Yeah, before COVID, you would pay off a statement or pay down your utilization ratio. The next month it reflected and you were up 40 points. Lenders could rapid rescore you. You looked amazing. Because of the CARES Act extension, and frankly, the CFPB kind of ruined our lives for the last year in my world. They stepped in and gave forgiveness essentially to the credit bureaus and said, as long as you show effort in responding in a timely manner. Can you imagine what that looks like for the credit bureaus? Timely manner and effort is not the same thing as the Fair Credit Reporting Act's hard 30 days, right? So what we've seen is although let's say you're late this month, that will absolutely be penalized on your credit report in 30 days. But if you pay something off, it could take 90 days for it to update. So unfair. It's like driving people bonkers because they're paying things down and not seeing the immediate reward. But if they're late, you better bet they're going to see the consequence.
Yeah.
Super frustrating. So again, everything right now with credit repair, although some of the CARES Act is extension is at its sunset, thank God. My best tip, which is very hard to explain to credit challenged people, now more than ever, you have to be proactive and not reactive. If your lease is up in a year, you need to talk to someone now because the chances of having anything fixed in 90 days, those days are over. We used to be able to pull literal magic tricks in 90 days. It's not happening. And the reason why I say that is because the credit bureaus are now allowed 45 business days to look to finalize an investigation. It used to be 30 calendar days. So now you're looking at 6 to 8 weeks of time to investigate. So I feel like a broken record in my office, but every time I talk to clients who are like, my lease is up in 6 months. Like, oh, now's the time. Don't wait till you're 30 days out. It's not gonna happen. It's kind of like joining a gym and saying, I want to be in a bikini next month. Well, should have started a little sooner. So we're just trying to really, get people to see that I don't have a magic pill, but we definitely have a program that works quickly if you get moving on it. Okay, next slide. Okay, collection accounts are going to be the death of me. I'm going to need way more Botox this time next year. Collection accounts are the accounts that can really make or break a consumer. Right now, more than ever, we're seeing an average, by the way, of about 20 open collection accounts on each credit profile that we see. In California, in California, the statute of limitations on collection debt is 4 years. What that means to the consumer is that they can be sued in the form of a judgment within that 4-year time, okay? 4 years and 1 day later, they can still report it. They can absolutely still continue to collect it, but they can't sue you in the form of a judgment, okay? The judgment's a big deal because if they sue you and win, which they will, then you get wage garnishments, and now we're on a whole nother level, okay? So when we're looking at collection accounts for consumers, we are telling them, we got to sit down, look at the statute of limitations on this. We need to determine which one should be settled in what order, because if they're not going to delete it, your scores do not go up. I cannot stress that enough. The payment of a collection account does not bring the scores up, it drops it. It's the deletion after payment that brings the scores up. So either they can negotiate the deletion as part of the terms of settlement, or they can dispute it through our program after it's been settled and have, by the way, an 80% chance of deletion. But it's not 100. So it's better to do it at the time of settlement if possible.
And how long does that stay on the record of judgment?
Indefinitely if it's unsettled.
And once it's settled.
We can get it off. Yeah, usually within 2 years, we can get it off.
And the way I've explained, because I've worked with Tiffany probably about 16 years, I think, with this stuff. But the way I've explained that to customers, because they get frustrated on the whole collection account stuff too. If they start understanding the timeline of everything, a collection that's 4 years old versus a paid collection that's 1 day old. When they're asking and frustrated about, why is my score going down? Well, you had a collection that was 4 years old. That sounds like that's a long time ago. You just paid it yesterday, you now have a paid collection that's 1 day old. And then like kind of goes on for them. So,
Yeah, so exactly, the payment date is more harmful than the payment was helpful when you reactivate it. Okay, the other thing about collection accounts is that they're constantly being sold. So when you have a client that has a charge off, the biggest misconception that the consumer says, oh, good, it was charged off. That doesn't mean anything to you, the consumer. You still owe the debt. The charge off is the quiet before the storm, before it's now sold to a secondary company. Okay, so that's typically the danger zone. You want to address the collection before it gets sold, because the new company is now going to report it as a new collection, which it's not, it's the same collection, with a totally different account number and inflated balance with penalties and interest. Now you're essentially dealing with it twice. So although that's against the FCRA, because you can't re-age an account, it still happens all the time.
Wow.
So we have to strategically look at these collection accounts. Now, the other thing that's really kind of a big fat bummer is we're not rewarded for doing the right thing. You mentioned with your son. Clients will say, well, I've been repaying, I'm in a repayment plan with such and such. I pay $150 every month to bring this current. That should be rewarded. Yeah, good, you're doing the right thing. Every month that you're paying a payment on a derogatory credit debt, you're reactivating that date again. So I will see clients that have not communicated that they're doing that on an account. I'll get 10 things deleted, and then they'll call me mad that their scores dropped 60 points. There's absolutely no way 10 deletions is anything but up, right? So as soon as I see that, I go, what'd you do? What have you been doing? And then I find out, oh, I was repaying this collection account, because even though I paid dedicated credit repair to be my credit person, I'm also messing with my stuff on the side. So this is why we have to literally handhold our clients and go, okay, no, you do nothing except for stay focused on what we're telling you to do.
Now, I remember sitting through your presentation, I'm not sure if we have time to go into this. So if we're doing something like a turbotenant.com and we're reading through these things ourselves, how far can we elaborate in asking those questions? And do we as homeowners, to renters do you have any insight on, what we should be asking? That to me, that sounds like a good thing, but those numbers are pretty darn low.
Mm-hmm. So this is where you kind of have to see like what your freedom is in doing that. I personally, for example, we provide a letter of participation for our tenants to provide so that it shows I'm proactive. This is not a personality flaw. This is a circumstance in my time, and I'm investing in my credit. To me, that's huge. If you've got a tenant that's willing to pay a couple $100s to start working on their credit and moving forward, so that's one thing. But you want to look at in that world specifically, it would matter. So let's say the score is 620, but you look and you're like, okay, well, they missed Old Navy, they missed this, but they don't have open collections for utilities or the things that would be just not acceptable. You want to look at what is late and when it was late, and then ask them to provide a letter of explanation if possible. But absolutely, we do provide that letter of participation now more than ever, not just to employers, but for the sake of renting. I was just sharing before the meeting, I have more people enrolling right now in order to rent than I do to buy, because the market's gotten so crazy for rentals. So yeah, it's a huge shift. Okay, next slide. We can slide right past that one too. Next slide, thank you. Okay, we just talked a little bit about authorized usership. I talked to you about the secured cards. There's some credit building accounts that I can also share that have almost like a CD-ish methodology. So I can go over that too. So just know if you have someone that's lacking credit or you can't figure out why your scores are stuck, a lot of times people will go, why is my score at 680? Just let me look at the credit report, because most likely they're just lacking positive credit. Next slide. Okay. If you are disputing something currently with the COVID guidelines, I think I mentioned it's 45 business days now instead of 30. Credit balances are now not updating until it's been about 60 days as well. And the other thing that we've seen is that the credit bureaus are no longer sending credit reports in the mail. So if you don't dispute via certified letter strategy, which took our cost of doing this up $30 per client per month, we have to send the letters out certified, or the credit bureaus will say they didn't get them.
Yeah.
100% of the time. In fact, they were telling our clients when they call,
So
we don't have anything,
DD.
so throwing them away,
Yeah.
which is
Can you
so
still rapid
unethical.
rescore now?
You can, but they're not rapid. That's the problem we're getting. We're getting that call all day long. Like, what happened to my client? I paid all this money to, and it's not updating right away. Okay, next. Okay, the only good news I have today, just kidding, is the Fair Credit Reporting Act, the Fair Debt Collections Practices Act, and the CARES Act are, if you know what you're doing, there is about 90 different ways to dispute the same negative item. So just because we may not get it removed the first time, we have literally mastered the art of using these laws to the consumer's advantage, which is the elephant in this room, is how do you get bankruptcies deleted that happened? Or how do you actually get collection accounts removed that should be there? The FCRA and all of the other stipulations, I won't bore you with, but essentially the burden of proof lies on the credit bureaus to receive the investigation, conduct their due diligence, and then be back in touch with the consumer with verification. So we've mastered the art of making the data hard to verify, not impossible to verify. So that's why not everything gets deleted. But the average case for us is someone in the low 500s needing to qualify for that standard FHA loan at 640, 680. That's now a 6-month client. It used to be 3 to 6 months. Now we're saying plan on it taking 6 months. Hopefully it'll return back to normal, but that's the deal right now. Any credit repair company out there saying otherwise is lying.
There's other ones out there?
Yeah, exactly. Nope, there's not. Move on.
Really, I didn't know.
Nationwide,
Who
yeah.
is doing the commercial right now? There's a big credit repair company that's doing TV commercials. And there's the one funny line in there. They're like, oh, isn't credit repair expensive? The guy goes, is it having bad credit expensive? My man. And then they
That's
go,
so funny.
I think I've seen that.
I gotta tell you, I have some serious, we've got just some nightmare stories of companies that do all kinds of things. So,
Are you nationwide yet?
we are,
Oh.
yeah, other than Georgia and Oregon, we work with clients
Can
nationwide.
I ask you why Georgia and Oregon?
They disallowed it legally. So it's not that we can't do it, no one can do it.
Why did they do that, do you know?
I have a couple opinions, but I think ultimately there are more fraudulent companies doing, or people, not necessarily companies, doing credit repair. The majority of the time when you hire a company that you haven't researched, it's someone doing credit repair as a side hustle or something. Frankly, a lot of realtors, they charge money up front and then they just kind of don't do anything, and there's no recourse, and there should be. So when you're registered with the Department of Justice, like we are, we have to bill in arrears. We have to provide 24/7 tracking capabilities for our clients to see to the minute what's being done, what their percentage of improvement is. So it's not just they call and, yep, promise we're working on it. They have to be able to see what's being done and have the ability to measure results. So, so it's just, and by the way,
It's just teaching the consumer the right way to do
education,
it.
yeah. By the way, Oregon and Georgia have the lowest FICO scores in the nation, so it's a little interesting. We were recently featured, actually about 2 years ago now, still, in the books, the Credit Repair Bible and Rapid Results, both of which are on Amazon, and they're very well written, how to do your own credit repair books, written by a credit repair guru, or excuse me, credit expert guru from the credit bureaus. And he actually sought out to prove that most credit repair companies were, fly by nights. And he ended up finding us and mentioning us. So I promise I'm not him, because I look at him like I look like I wrote the book or something and put it on there. I should do that though. Come up with something. Okay, next slide. Okay, the only way that credit repair doesn't work, literally the only way. Worst case scenario, I would not be able to fix anything and you would be the exact same as you started, right? In which case, we wouldn't be in business if that was the case. But the only way for credit repair to fail is new late payments, okay, new collection accounts, new credit inquiries, paying off collections when told not to, and then, oh, by the way, the establishing of new credit. So this is very frustrating because when I'm sitting down during a consultation and I'm telling a consumer, you need 3 credit cards and you don't have them, right? They go do that and then they go down in their first 2 months, they're down 40 points. That's where we have to educate. Yes, it's kind of like starting a diet, and I don't know if you've ever done that whole like protein thing. And all of a sudden, like, oh boy, I gained weight, and that was the exact opposite of what I was trying to do. You go backwards to go forward. So in order to have 30% of your FICO score created for you, you have to obtain new credit, which means for about 90 days, you're going to lose 15% of your FICO score. Okay, so it's really important. Timing is everything. So even though I'm going to tell you, you need credit, you may not need to do it first. If you only needed 25 points to qualify for the mortgage, then we get you into the mortgage, secure that first. Then we start building on your additional credit lines so that you can be a 720 down the road. Okay. Again, timing is everything. Next one. Forbearance versus deferment. Okay, so this is kind of a new thing, right? We're all seeing quite a bit. It wasn't new to us in that, gosh, when Adam and I first started talking about, was it 2006 or 7? I don't even know.
Probably.
One
I
in,
started at 5, so.
yeah, 1 in 4 homes were in foreclosure, or I mean, we did stuff in this
Yeah.
building all day long for people that were literally short sell, short sell, short sell. So we anticipated what this was gonna look like early, and because we went through 2008 already. Fortunately, it's not been that way. For the most part, you don't have a bunch of inaccurate things, and it does happen, but it's not happening like we expected it to, because back in the previous time, it would just be 30-day lates that were on the credit report because they were being told you have to be 6 months late to negotiate
Right.
short sales, etc. Now, because of the CARES Act early intervention, there was almost no reporting at all, which also damaged people because people that were paying on time, they weren't getting credit for those 6 months, that early 6-month window. So just the good news is that forbearance hasn't really been a thing yet. We haven't seen a lot of it other than in the school loan issues. But I think what we're starting to see during our consultations is a lot of people that decided that they didn't need to pay their mortgage, and they went and bought a motorhome, and they went and bought desert toys and boats. Everyone in Lake Havasu with a new boat. Just kidding. That's really a big deal right now. So we're gonna see a
It's just like
huge
that.
window.
It's almost like 08 when they were getting 60 grand over asking price.
So we'll see. This is to be determined, and we're on the front end of this as far as what we're doing. We're already filing CFPB disputes for our consumers, especially when you have right documentation. There's so many people that are like, no, this is my contract. I docu-signed that I was going to be 6 months without payments. Hands down, we can process it right away. Okay, next slide. What I will say in this deferment versus forbearance issue, we want to make sure that instead of getting caught up in what the difference is, it's more about what's the repayment option going to be. That's what everyone says. What do I ask my lender? You need to ask very specifically, what does the repayment look like? Is this at the end of the loan? Am I going to have an increase in my mortgage every month to pay for, that kind of thing. By the way, I have a worksheet on this that I'm emailing my clients. So when they call, they know what to ask. So if you have somebody that's in this circumstance, just have them call me.
I'd be happy to put that on my Facebook page.
Okay,
Yeah.
Yeah.
With your information.
Sure. Thank you.
Yeah.
That way and also I have the same thing for collections. So, because there's so many caveats to collection accounts, I have a worksheet that my clients can use and say, okay, here's the right things to ask during the settling of a collection. Okay, and some tips and tricks as to how to do it.
But why do they need that? Because you're settling their account.
We don't settle the account.
Oh,
We used to, but we don't. So now we teach them, we dispute them for deletion, but we tell them these 4 accounts, we give them an Excel spreadsheet and say, here's the best phone number to call, here's what you say. The reason why we don't settle collections is because we have a team of 9, and when we would do that for clients, they would not pay. So we'd have all these hours of phone time settling collections, negotiating, our clients would not pay, and then our phones would ring nonstop with collection companies.
okay.
So we were like, nope, no more. We'll tell you how to do it when you've got the money, settle the collection and do it that way. But there's a wrong way to do it. And that's where we have to say, okay, ask these questions, make sure that if you do pay it, you screenshot the payment and email it to yourself. Because when it does get sold, after it's been paid, you need proof. So we have all kinds of things that we tell you.
Gotcha, interesting, okay.
Next slide. Okay, this is where we talked about the repayment plan, the deferment, the modification, and the reinstatement. And this is what the worksheet will cover for your clients if they're in that situation. Next slide. Okay, this is where people say, can the forbearance or deferment hurt you? It really is all about documentation. It's all about documentation and what months. So for example, we have a lot of clients right now that had the documentation, but they're trying to extend it. So they had to come back with a certain amount of payment. They're in arrears right now. So even though they're making a payment, they're still short every month the amount that was supposed to be paid. So those 30-day lates are collecting and they're rolling lates. And there's nothing we can do about that. It's got to be made, you need to make the loan whole according to the terms. When I say nothing we can do about that, I mean, we have to dispute it, but it's not 100% chance of removal as if it would be if there was documentation. Okay, next slide. Next slide. Okay, FICO Score Resilience Index. The next slide will be more visual, I think. Then I'm almost finished. Okay. This one is the low balance on revolving credit. So essentially what they've done is they've created a new system. It's 1 to 99, by the way, and it's grouped on the next slide. It'll show us exactly how they calculate it. There we go. 1 to 44 is the most resilient to change. Now keep in mind, this is where the lower the better. This is the only score where the lower the better. My FICO resilience is 35. So I was like, what in the world? I have not missed payments for years. But I have a lot of newer credit. I refinanced my vehicle and I had paid off my solar loan. By the way, that's another thing that happened. So when you look at these, they're trying to create a safety net for creditors because of everything that's happened during this. So they want to have a resilience index. Very sensitive to change in economic conditions is 70 to 99. So to my knowledge, we're one of the first companies to even mention this because I think mortgage lending right now is the first to implement it, and they're already starting to see it in underwriting. So I'm getting a lot of calls on it. Other than me knowing what it is, I have no idea how to implement this for you yet. I just want you to know about it, and I certainly don't want to
So the lower the number, the better.
Correct. So what they're doing with underwriting is they're taking your mortgage FICO. They're also looking at your resilience index, but it's so early on. By the way, this is a month old. So this is cutting edge new.
Okay.
So I don't even have enough information to tell you what to do about fixing the index, other than I want you to know it's there and we're like full-time speed ahead trying to understand it. So just, if you hear it, just remember we talked about it, and I'm in full student mode right now, trying to learn how to correct it.
Who makes this up?
FICO.
Just because.
The credit card
Got nothing to
companies.
do today.
Yeah.
Incredible.
So remember, the credit card companies and lending institutions are who keep FICO alive. So they needed to come up with something. The other question
Will
I'm
that
getting,
show on myfico.com?
it will at the very front page bottom,
Okay.
brand new
I'm
product.
gonna pay for that.
Okay, what I don't know is how to fix it yet. So we're working on that. I'm assuming a lot of that will be something that I'll learn right away, but we just know that it's being implemented. Oh, the other thing I'm asked a lot right now is what FICO score do the mortgage lenders use? Used to be 9 and 10. Used to be, we knew 9 and 10 were gonna be FICO 9 and FICO 10 were the most widely used in lending. Now it's 5, which is the oldest, one of the oldest models, but it's also the less generous of the 3. So that seems to be turning. So that's why I like the MyFICO report, because you should really look at all of them and just kind of get a feel for where you're at. Okay, next. Okay, this is my other good news moment, rental reporting. Please have your tenants call me. We can report up to 2 years of rental history to all 3 credit bureaus, and within 45 business days, you'll see a boost in score. I know everyone's listening to the Experian boost and all of the report your utility thing. I've always been a little bit skeptical of the Experian boost because for obvious reasons, you're giving the credit bureau access to your banking information. Never a good thing, in my opinion, especially for credit challenge clients who don't tend to pay their bills. But you can do that, and we do help clients do that when we need to. Experian, though, we would only do it if Experian was the middle score and they needed about 20 points. So if your
Gotcha.
Experian score doesn't need it, don't give them the information for no reason.
So when I go into my Experian account and it tells me my score, I should believe it?
No,
Okay.
because
So I
it's
go
a
to my
FICO
FICO.
score.
Okay.
Yeah, if it's not a FICO, it's a FICO.
Okay.
Unless you're buying a FICO product from Experian, but even then, you don't know which product you're buying because
Gotcha.
they're all different.
Okay. So do I need Experian?
I mean, I think it's useless to me. The only thing that Experian would be good for is notifying, which even then it's not very on time.
Oh.
If you're looking at it for monitoring, go
Yeah,
to LifeLock.
I did go to LifeLock and I didn't care for them, so I went to Experian.
You can go wherever you want to go.
I
as
went to
long as-
LifeLock and they never explained to us, I know this is, I'm gonna tell you my personal life, but they never explained to us that we had to upload all of our accounts. So we were paying on LifeLock for all these years, then all of a sudden, our Bank of America got hit and Bank of America is calling us saying, hey, there's fraudulent activity on your account. And we called LifeLock saying, why aren't you telling us this? Well, you never put your accounts on. So we
Huh.
were really naive.
Yeah,
So I thought, okay, I'm gonna do this right. And I went to Experian.
okay, so I've never heard of that happening. I have LifeLock also. I also have Identity Guard, my FICO, I have Experian, and I have credit card. I have all of the ones so that my clients will be like, I know what they're talking about when they tell me they have.
Right, uh-huh.
I love LifeLock. It texts you immediately upon someone using any of your information. What I don't love is people putting locks on their credit or freezes, which is also another slide coming up.
Oh,
If you put a freeze on your account, you are putting your social security number in prison. And what will happen is you may actually get a mortgage pull, the first inquiry, but it triggers after the pull. Then it locks. Well, you go on and know it was locked because I got my credit report from Adam, right? And then when you go to close, you're trying to close, they pull it again, you're locked and frozen. You then have to send fax, notarize all this information to the credit bureaus, hope they're gonna be accountable for receiving it. And I can't tell you how many escrow disasters we have
oh.
because of the lock.
I have mine locked. I thought I was being safe.
Take it off, yeah, take it off.
Mm.
And even when you take it off, it's going to pop up whenever inconvenient time you're trying to do something. It's just a pain in the rear end. So
Okay.
LifeLock, I like Experian for updating, but I will tell you, I mean, because of what I do for a living, if it's not accurate, I don't want it. So Experian's not accurate, it's not on time, and the scores are wrong. So I would say go to my FICO and pay for a subscription. I think it kind of covers all of it. You get all the updates and the right scores.
Okay.
That's my opinion. Okay, I got some credit tips for my cute little cartoon. All right, always receive paper bills monthly. This is really unpopular. People hate when I say this. If you don't touch it, feel it, see it, you don't think about it in this day and age, right? And unfortunately, so many credit card companies have annual fees, certain things you won't know about or remember that are there. Please don't, all the surprises that pop up in fees and penalties, just because you're on automatic payment, that doesn't mean that that's going to cover any excess, any other fees or things like that. So even if you are making a payment of $35 every month automatically, you didn't see the statement that the 12th month of that account required an additional $25, you'll have rolling lates for 4 or 5 months without noticing it, all on a little tiny fee. So this is one of the biggest reasons why I have clients is that they don't have paper bills and they're on automatic payment.
That's because most places are charging for paper bills.
I know, and you have to opt in now to get them. I noticed that. Always pay your final payment of a lease or refinance. Okay, this happens constantly. So I see this in vehicles, we see this with home purchasing. When you're refinancing your mortgage into a new mortgage, oftentimes the lender's like, you're good, we're gonna pay off this final month, and you still have a month without a mortgage payment because the new loan, right? Pay that mortgage. Let them reimburse you. because I cannot tell you how many times it's not handled appropriately. Then I've got a lender freaking out saying, I'll pay for the client's credit repair we screwed up and it didn't get paid in time for them. Don't ever trust someone else to pay your bills. That's my rule of thumb. Get reimbursed, if possible. Never dispute items online. People go on and click, and they dispute things through Credit Karma. All you're doing is matching information. You're not verifying information. So never good. Be hesitant to put a freeze on your credit. We talked about that. And then lastly, co-signing. This happens 1 in 5 times. When you're co-signing for a kid, frankly, or whoever, for a vehicle, the best practices to avoid drama in your financial life is that you pay the payment. Don't do it unless you can afford the payment every month. Then have the person that's paying Zelle you or Venmo you. Because if you are in real estate or you need your FICO scores, I've got a commercial developer right now that's in my program that's like, my son moved and didn't get the bill and blah, blah, blah. And it's now like a huge problem. You know, we're trying to get it resolved. So best practices are you pay it, mom and dad, and then and then chew Johnny's ass if he doesn't pay you. Because it happens all the time. You have any questions about that? Okay, next slide. Okay, checking your credit every single month. This is but again, this is what I do for a living. So for people that say I only do it once a year, you would be mind blown to see, and frankly, probably discouraged a little when you see how active the FICO score really is. There are certain times of the month that you pull your credit and you happen to have gone to Costco and filled up it's amazing how fast you slide 40, 50 points. It is not static. Just because you think you're 820, you could easily drop to 700 and not even know it. So it's very important to be checking that, especially with
Should we be concerned when it drops that low?
this is why I think monitoring is important, because you'll know why.
Okay.
So if it dropped because you have a new late payment, then of course that's a big problem.
All right.
If it dropped because they go, oh, your credit card utilization went up, Christmas time, everybody's scores dropped and they're like, well, I don't have any late payments. Well, we all did Christmas, right? So then we have that swing. Okay, next slide. Oh, look it's the end. So this is my, this is my information. I really appreciated coming in today because I have found my entire business model has switched to renters right now. So if you have someone you're trying to get into a home that's renting right now, please send them over for that free consultation. And we'll definitely handhold them. That's what we do good, what we do well, excuse me, is we handhold. I'm a professional adult babysitter right now. And I love it.
So you're a realtor.
Yeah, welcome.
What I hear sometimes is from the agents, they send their clients in a bad credit because they can't get them a loan to someone like you. You get their processed and their FICO scores go up, and now they can buy. But in their mind, they're thinking, oh, I had to pay 20% down. Now I qualify for other loans, I can get a 4% down. So 2 days before escrow closes, they go buy new washers and dryers and refrigerators. It happens all the time.
Do they need them or they should wait for them?
No, it kills their credit because they rerun their credit right before the escrow closes.
It happens all the time.
Can you get them to sign in blood that they won't buy anything when they're in escrow?
I wish. I mean, that is a very common thing. But here's one thing too I want to mention. 1 in 4 people need this. And the clients that we're working with now, this has been a huge shift, are everyday awesome people. Like this was just a circumstance, a divorce, which by the way is on the rise, big surprise with COVID. A lot of things have happened that would make normal people, when I say normal, need credit repair. It is not the people you don't want to work with. That's the misconception I always have, and I'll have lenders who've been in the business forever. Oh, I don't work with credit challenge clients. You're basically saying you don't work with people that just went through a divorce, or lost a spouse, or had something happen that's really important. So I just like to always mention that our clients are amazing, and they just need help, and they need accurate education, and that's what's lacking. I think that's it. I know it's kind of probably quiet over there.
Yeah. You guys have any questions over there?
I don't think so. You covered it all really well. Thank you very much.
Well, thank you for having me.
I'll take a stack you.
And I'll give another plug for Tiffany. I mean, I have referred numerous clients to her. I've used her personally, and
So have I.
we go way back. But in addition to being obviously well-informed and understand everything, her and her company are extremely ethical, because I've actually referred people over for a free consult that haven't been a good fit. Whatever their goal was, they said it's either not attainable or just bad timing, and they've said, okay, and we'll come back later or whatever it is. So to me, that's extremely important. You're not just sending somebody to say, hey, go sign up. They're gonna take a few $100s, and if it doesn't work out, it doesn't work out. There are those people out there, but not
Thank
today.
you. Yeah, and by the way, who wouldn't be a good candidate are people late right now. And that's one thing I always say, like, who would have taken that client? If you're late on 5 things right now, I can't make up for that. I could remove 9 things and you're still gonna drop, because new lates affect 80 points, right? So I always like to make sure the financial hardship is yesterday. And when I say yesterday, at least 6 months ago. It cannot be, and honestly, even then it's kind of early. So in those cases, we'll tell them, you know what, instead of not doing anything, let's focus on building some positive credit. Take the next 4 months to establish some credit, go to these 4 places and get some credit cards, and then come back to us. And thank you for saying that, because it does always bear fruit when people realize that we weren't taking advantage. So, okay, I've talked too much. I'm
Very interesting, thank you.
Thank
Tiffany.
you.
Always interesting. to
I
listen to.
learned several new things from you.
Oh, good, good.
Great,
My own voice is
Thank
annoying
you.
right now, so I'm gonna stop talking.
all right.
You know that feeling where you're like, I feel like all right, should I finish your meeting? Is there more to the meeting?
No, you can hang out, it's fine.
Okay.
Thank you very much.
Thank you.
For, our new business, since we have run overtime, we are gonna go ahead and, it's not, mandatory that we do some of the, do the motion for Michelle and so on, so we're gonna skip that and have it for next time. I think I'm under the understanding that we are gonna be live though be at a next month, correct?
Zoom only.
Zoom only,
Yeah.
but are we all supposed to meet there and be in the big room, or?
We can, we're making it, we're gonna be broadcasting it in our Marietta location, also in Hemet, or you can watch it from Zoom, from wherever you are.
Okay.
Yeah.
Okay, so for sure, Walter, I'll be there next month in Temecula. Real quick, is there any, quick pitches that anybody wanted to make?
No, thank you.
Okay, all right, so then we will go ahead and adjourn, and we will see you next month on September 8th at 10 a.m. in Temecula,
Or via Zoom.
or via Zoom, either way.
The speaker will be on Zoom.
So you're gonna send out a Zoom for everybody?
Yeah.
Okay, all right, thank you.
Bye, you guys.
Meeting adjourned.
Thank you.